Gold at 51.20, silver at 85. And if you look at the silver 4-hour chart right now, you will see something that I need you to understand before anything else in this video. Silver is being squeezed into a triangle that is about to run out of room. Pull up the 4-hour chart. You can see it clearly. The descending resistance line coming down from the highs and the ascending support line coming up from the lows are converging right now. The range is getting tighter with every candle. The volatility is compressing, the energy is building, and this triangle on the 4-hour chart has maybe 2 or 3 trading days left before the apex. After that, the price physically cannot stay inside the pattern. It has to break one direction. And here is what makes this triangle so dangerous. If silver breaks to the upside, the measured move from this pattern points to the 105 area. If it breaks to the downside, the target is the low 70s. That is a $30 difference depending on which way it breaks. Explosion or collapse. And based on everything I am about to show you in this video about what the banks are doing with physical gold, what Iran just threatened, and what is happening in the war, I think the odds favor the upside break. But I want to show you the data and let you decide. Because while silver compresses into this triangle, the war just expanded into territory that nobody saw coming. Iran is no longer just hitting military bases and oil infrastructure. They are now threatening to target American data centers across the Middle East. Amazon Web Services, Microsoft, Azure, NVIDIA facilities, Oracle, IBM, Palantir. The names they listed are not oil companies. They are the backbone of the digital economy. Banking systems, medical records, cloud storage, every app on your phone, and Iran just said those facilities are next. While that threat is sinking in, let me tell you what happened on the COMEX gold delivery desk today because the numbers are staggering. Morgan Stanley issued 1,738 gold delivery contracts in a single day. One firm, one day, 1,738 contracts. That is 173,800 ounces of gold being pushed into the delivery system by one bank. And on the other side, Bank of America stopped 602 contracts. JP Morgan stopped 298, Barclays stopped 502, BNP Paribas stopped 211, Wells Fargo stopped 200. The biggest banks on the planet fighting over physical gold while Iran threatens to blow up the internet. This is not a normal week in markets. This is a week where everything is changing at once. And I am going to walk you through every piece of it. The war escalation into data centers and non-allied countries. The gold delivery data that tells you exactly who is positioning for what comes next. And what the oil crash from 119 to 81 means for gold and silver going forward. Welcome to the hidden economy. Hit subscribe and hit the hype button right now. The war is no longer just about oil. It is about technology, infrastructure, water, and the banks are responding by grabbing physical gold at a pace I have never seen. Let's go. Let me start with the gold delivery data, because what Morgan Stanley did today deserves its own section. Pull this up on screen. COMEX Gold Futures Delivery Notice. March 10th, 2026. Settlement price, $529.70. Month tote, 7,500 contracts. That is 750,000 ounces of gold. Now, look at the names. Morgan Stanley issued 138 contracts out of the 1,875 total. That is 92.7% of all gold delivery notices issued today, coming from one single firm, and 92.7%. Morgan Stanley, one bank pushing 108,800 ounces of gold into the delivery pipeline at $5,200 an ounce. That is over $900 million of gold from one firm in one day. Let me let that number breathe for a second. 900 million, that is not a trade. That is not a hedge. That is a strategic decision by one of the largest financial institutions on earth to move nearly $1 billion of physical gold in a single session. And the question you should be asking is why? Why is Morgan Stanley pushing that much gold into the system right now? What do they know? What are they seeing? What are they positioning for? I want to share something personal here. I look at delivery data every single day. I have looked at it for years, and most days the numbers are what you would expect. A few hundred contracts here and there. Normal institutional flow. Nothing that makes you sit up in your chair. Today made me sit up. 1,138 contracts from one firm is not normal institutional flow. That is a statement. That is Morgan Stanley making a move that is so large it cannot be hidden. And when a firm that size makes a move that visible, it is because they want the market to see it. They want other institutions to know they are positioning. It is a signal, and the signal says we are going heavy into physical gold right now. On the stopping side, the names tell you who is accumulating. Bank of America stopped 602 contracts at $5,200 per ounce. That is over $313 million of physical gold in one day. Barclays stopped 502 contracts. That is another $261 million. JP Morgan stopped 298, $155 million. BNP Paribas stopped 211, $110 million. Wells Fargo stopped 200, $104 million. Add it all up. In a single day, the stopping side of the gold delivery market absorbed over $940 million of physical gold. Bank of America alone took over $300 million. Barclays took $261 million. JP Morgan, $155 million. BNP, $110 million. Wells Fargo, $104 million. Capital took 37 contracts worth another $19 million. Even ADM took 19 contracts. Every single firm on that list is a major global institution. And every single one of them was on the buy side today. Not one was selling. Let me say that again. Not one major institution was net selling gold today. They were all buying. All of them. At the same time, that anonymity is what stops me in my tracks. When Bank of America and JP Morgan and Barclays and Wells Fargo are all doing the same thing on the same day, that is not a coincidence. That is coordination. Not in the illegal sense, in the formational sense. They all have access to the same macro data. They all have teams modeling the same war scenarios. They all see the same vault drain numbers. And they have all arrived at the same conclusion. Get physical gold now fast as much as possible. And month to date, the total is now 7,500 contracts, 750,000 ounces. At current prices, that is roughly $3.9 billion of gold demanded for delivery in March, $3.9 billion in 10 days. I have been tracking COMEX delivery data for a long time, and I want to be honest with you. I have never seen numbers like this. The pace of gold accumulation through the delivery system is unlike anything in the data going back decades. And it is not one bank. It is all of them. Bank of America, JP Morgan, Barclays, BNP Paribas, Wells Fargo, Capital. Every major institution is on the stopping side, grabbing physical gold. That kind of unanimous institutional behavior tells you something is happening behind the scenes that the public is not being told. When every major bank simultaneously accelerates physical gold acquisition during a war, you pay attention because they have information and models that retail investors do not. And their models are telling them to get physical gold into their vaults as fast as possible. Now, let me tell you why. Because the war just entered a phase that changes the risk calculus for every financial institution on Earth. Iran announced this week that it may target American technology infrastructure across the Middle East. They specifically named Palantir, Microsoft, NVIDIA, IBM, Oracle, and Amazon. These are not random names. These are the companies that operate the data centers and cloud infrastructure that run the digital economy of the entire Gulf region. Amazon Web Services has major cloud regions in Bahrain and the UAE. Microsoft Azure operates across the Gulf. These facilities process banking transactions, store medical records, run government systems, handle commercial data for thousands of companies, and Iran just said they might blow them up. I want you to think about what that means for a second. We have been talking about oil supply disruption for 2 weeks. Oil is critical. But data centers are the nervous system of the modern economy. If AWS goes down in Bahrain and the UAE, the banking systems of those countries could freeze. ATMs stop working. Online banking goes dark. Credit card transactions fail. Hospital records become inaccessible. Government services go offline. Commercial transactions halt. Supply chain management systems crash. The smart city infrastructure that Dubai has spent billions building goes blind. It is not just an economic disruption. It is a civilizational disruption. And Iran just put it on the table as a target. And think about what this means for the companies named Amazon, Microsoft, NVIDIA, Oracle, IBM, Palantir. These are some of the most valuable companies on Earth. Their stock prices are built on the assumption that their global infrastructure is safe and expanding. Iran just told the world that infrastructure in the Middle East is not safe. It is a target. Even if Iran never follows through on the threat, the insurance premiums on those facilities just went through the roof. The risk models just got rewritten. And any company considering expanding data center capacity in the Gulf region just put those plans on hold indefinitely. That is billions of dollars of future investment frozen by a single threat. This is why I keep saying this war is different from anything we have seen before. Previous conflicts disrupted oil. This one is disrupting oil, shipping, aviation, water supply, and now digital infrastructure. There is no sector of the economy that is safe from this war. It does not need the internet. It just sits there being valuable. And right now, with Iran threatening to knock out the digital infrastructure of the richest region on Earth, that simplicity is worth more than ever. And the escalation is not limited to data centers. Iran struck an oil depot at the port of Salalah in Oman this week. Oman, a country that has been acting as a mediator between Iran and the West throughout this conflict. Oman hosted the nuclear talks. Oman's foreign minister said a breakthrough had been reached just days before the war started. They were the peace brokers, and Iran hit their oil infrastructure anyway. That tells you something that I think most analysts are not processing correctly. Iran is no longer making strategic calculations about who to hit and who to spare. They are hitting everyone, allies, neutrals, mediators, everyone. When a country at war stops distinguishing between enemies and neutral parties, it means one of two things. Either their command and control has broken down and strikes are happening without strategic oversight, or their strategy has shifted from targeted retaliation to total regional disruption. Both options are terrifying for global markets because both mean that nowhere in the Gulf is safe. Not for oil, not for shipping, not for data centers, not for banking, not for anything. Iran also struck a Thai flagship in the Strait of Hormuz. Thailand has nothing to do with this conflict. They're not a U.S. ally in this fight. They are not providing military support, but their ship got hit anyway. The message to every shipping company on Earth is now unmistakable. It does not matter whose flag you fly. If you are in the Strait of Hormuz, you are a target. And that is why the strait remains essentially closed with roughly 150 ships stranded and 20% of global oil supply disrupted. Citibank is evacuating their Dubai office. Let me say that again because I wanted to register. Citibank, one of the largest banks in the world, is physically removing its employees from Dubai, the financial capital of the Middle East, the city that has branded itself as the safest and most stable hub in the region. Citibank is leaving. When I saw that headline, I stopped what I was doing and sat with it for a minute. Because banks do not evacuate offices for headlines. They evacuate when their internal risk models say the probability of a direct impact has crossed a threshold that makes staying irresponsible. Citibank's risk team has access to intelligence and modeling that the public does not. And their model said, get out. And the IRGC spokesperson said something this week that I think is the most important statement of the entire conflict so far. He said, the United States is now trapped in a quagmire. That is not a threat. That is an assessment. And here's why I think it is the most important statement of the war. Iran is telling the world that this conflict is not ending quickly. Regardless of what Trump says at his press conferences, they have a new supreme leader in Mojaba. They've shown they are willing to hit oil infrastructure, civilian water supply, non-allied countries, random shipping vessels, and now they are threatening the digital backbone of the modern economy. This is a country that has decided it has nothing left to lose. And countries with nothing left to lose are the most dangerous adversaries in any conflict. I have studied enough conflicts to know that the word quagmire is never used lightly. Vietnam was a quagmire. Iraq was a quagmire. Afghanistan was a quagmire. Every quagmire in American military history lasted years longer than anyone predicted and cost trillions more than anyone budgeted. And Iran just used that exact word to describe where America is right now. Whether they are right or wrong is beside the point. The point is that Iran believes this is a quagmire. And a country that believes it is winning a war of attrition does not negotiate. It digs in. And a dug in Iran means a longer war. And a longer war means more inflation, more disruption, more instability, and more gold buying by institutions who see the same thing I see. Now, let me connect all of this to what crude oil did this week because the price action tells you exactly how the market is processing this information. Crude oil touched $119 when the futures opened after the oil depot bombing in Thran. Then Trump held his press conference from his Dow resort in Florida. He said the war would be over very soon. He said U.S. military objectives are pretty well complete. I said he would waive certain oil-related sanctions. He said the U.S. Navy would escort tankers through Hormuz. Oil crashed to 81 on those comments. $38, 32% in one move. But here's what the market missed in the chaos of the press conference. On the same day, Trump told the public the war is almost over. He told House Republicans behind closed doors that we have not won enough. Same day, two completely different messages. One for the cameras designed to calm the oil market. One behind closed doors telling the truth. And when that contradiction leaked, oil bounced from 181 back to 85 and gold recovered above 100 years. This is what I mean when I say you cannot trade this market on headlines. The headlines contradict each other hour by hour. The only thing you can trade on is the delivery data because the delivery data does not lie. It does not give one message to the public and another behind closed doors. It just shows you who is buying and who is selling. And right now, everyone is buying gold. Then Iran made their statements about not allowing a single liter of oil to pass through Hormuz and oil bounced again. The market is swinging $30 and $40 on individual headlines. Here's what that volatility tells you. The market has no idea how to price this conflict. It does not know if the war ends next week or lasts 3 months. It does not know if Hormuz reopens or stays closed. It does not know if Iran follows through on the data center threats or if it is a bluff. And when the market does not know, it swings violently in both directions on every headline. And here is what I find fascinating about gold during all of this. Gold pulled back to $51.20 today. But look at the bigger picture. It crashed from 5,200 to 5,000 earlier this week and recovered right back. Gold is finding a floor. Despite the dollar strength, despite the headline volatility, despite crude oil swinging $40, gold keeps coming back to the 5,100 to 5,200 range and refusing to break lower. That floor is being built by the delivery data I just showed you. $3.9 billion of physical gold being demanded in 10 days. That kind of institutional buying creates a floor that headlines cannot break. Silver AT85 is more volatile because of its smaller market size and the short positions we discussed in the previous video. But silver is also finding support. It dropped from 89 to 85 and is holding. The higher low structure from the last few weeks is being tested right now. If 85 holds and silver bounces, the next attempt at 90 comes from a base that the shorts will find harder to defend. And here's what ties the gold delivery data to the silver market. When institutions are grabbing gold at record pace, it means they expect the macro environment to get worse, not better. Worse macro means more inflation. More inflation means more pressure on the dollar eventually. When the dollar finally cracks under the weight of inflation and war spending and energy disruption, silver does not just follow gold higher. It amplifies the gold-silver ratio, which is currently around 60, compresses toward 40, and then 25. And the math on those ratio targets puts silver at 150 and then 280. That is the roadmap, and the gold delivery data tells you the institutions are positioning for exactly that roadmap right now. Gas lines have started forming in China. The effects of the Hormuz closure and Iranian strikes on Gulf oil infrastructure are already hitting the world's second largest economy. China imports massive amounts of oil through the strait. With that supply disrupted, Chinese consumers are feeling the impact immediately. Gas lines in China in 2026, that is a headline that should terrify every central banker on earth. The world is getting less stable. The war is expanding into new domains, technology, water, non-allied countries, shipping lanes, data centers, and the institutions with the most information and the most capital are responding by accumulating physical gold at a pace that breaks all historical records. They are telling you with their actions what they expect is coming, and what they expect is coming requires a lot of gold. Now let me tell you what I am watching for the rest of this week. The gold chart is building a strong base between 5,100 and 5,200. Every dip below 5,100 is getting bought aggressively. The delivery data is the floor builder. $3.9 billion of institutional demand in 10 days does not allow the price to break lower. If gold holds above 5,100 through the end of this week, the next attempt at 5,300 and then 5,400 becomes very likely. And each $100 higher on gold compresses the gold-silver ratio, which means silver gets pulled higher with it. Silver, at 85, is sitting at the intersection of the gold rally and its own short position dynamics. If gold pushes through 5,200 and holds, the pressure on the silver shorts at 89 to 90 becomes unbearable because you cannot be short silver while gold is breaking out to new highs. The ratio compression forces your hand, and when the shorts cover, silver does not move 5 or 10%. It moves 20 or 30% in days. That is the leveraged nature of silver during gold breakouts. And the gold delivery data tells me the breakout is being built right now underneath the surface by the biggest banks in the world. Drop a comment. Tell me what you think about Iran threatening data centers. Tell me if you think Morgan Stanley's 1,738 contracts in one day is the biggest single firm delivery notice you have ever seen. Tell me where you think gold goes from here. I will pin the best analysis. Share this video. The gold delivery data and the data center threat are things that most investors have not connected yet. Help me reach them before the next escalation. If you are new here, hit subscribe. I cover comics delivery data, war impact analysis, and the institutional positioning that tells you where gold and silver are headed. Links in the description. This is the hidden economy. Gold at 51.20, silver at 85. Morgan Stanley pushing 1,738 gold contracts in a single day, $900 million from one firm. Bank of America grabbing $313 million. Barclays, $261 million. JP Morgan, $155 million. BNP, $110 million. Wells Fargo, $104 million. Every major bank on the buy side, not one selling. $3.9 billion of gold demanded in 10 days. Iran threatening Amazon, Microsoft, Nvidia, Oracle, IBM, Palantir data centers. Oman oil depot bombed. A mediator country attacked. Thai ship struck in Hormuz. Citibank evacuating Dubai. Gas lines forming in China. Oil swinging $40 on headlines. And the IRGC saying America is trapped in a quagmire. A huge move is coming. I can feel it in the data. The compression in silver, the base building in gold, the delivery acceleration, the war escalation, everything is converging. It could be in the next 2 or 3 days. It could be Monday, but it is close. The banks are grabbing gold like their survival depends on it. When I look at the delivery data and the war escalation happening simultaneously, I understand why. Maybe you should too. Follow the data, not the noise.